Okay, hi everyone. This is going to be the first lecture on chapter 22 for S Corps. So let me kind of get that out of the road there and get this ready to pull down. So what are we talking about here with S Corps? So the idea as a starting point with an S Corp, and people often confuse this, is it's purely a tax status. In other words, it's not a type of legal entity. Usually what happens, how you are taxed as an S Corp, is essentially you're a C Corp, that's kind of your beginning tax status, and then you affirmatively elect to be taxed as an S Corporation. So it's never like the default, you have to be affirmatively choosing to be taxed as an S Corp. In reverse, right, another thing people confuse is like LLCs, right? So LLC is a legal entity that is not a tax status. Normally, LLCs, they're going to be taxed as a default for partnerships, 1065. In any event, why we care about S Corps is because they have a type of flow-through taxation. So they're going to be similar to a partnership. But at the same time, they're going to have and possess a lot of those legal characteristics of a C Corp. So for this reason, they're kind of a hybrid entity, right? They're like the platypus. They're like part duck, like part whatever that other animal is. So you can see here with a S Corp, you kind of get the best of both worlds. It's like a C Corp with regard to formation, liquidation, reorganization. However, it's like a partnership with regard to taxation, right? It's going to be flow through taxation. All right, so how do you go about forming an S Corp, right? How do you do this? Well, we said, hey, you have to make an election. And generally, right, we're going to follow the same or similar rules for C Corps with regard to formation, namely Section 351. So what does this mean? Hey, you give property. I have a machine for my stock in the S Corp. As a general rule, this is going to be a disposition event, namely the amount realized minus the adjusted basis equals a gain or loss. However, Section 351 comes in and says, hey, if you contribute property for stock and immediately thereafter, the control group, everyone who gave property for stock, owns 80% or more of that corporation, then the transaction, despite being a disposition event, is going to be tax deferred. We'll kick the can on that gain. And in this framework, right, you're going to take a carryover basis in your stock. In other words, whatever your basis in your machine was that you gave for your stock is now your basis in the stock. It carries over, right? So this is the idea with it, formation 351. All of this is meant to encourage people to form corporations, right? And again, just to kind of emphasize here, we have to keep things in our heads straight. There's a difference between a C Corp, right, the 1120, that is a type of legal entity, versus the S Corp, which is a type of tax status that files the 1120S. Okay, so say you want to file an S Corp, right? Well, what are the requirements? Well, the idea here is not everybody can be an S Corp. Ideally, right, they're designed for small to mid-sized businesses. And depending on the firm you go to, right, you're more likely to see S Corps at like a regional firm or a small firm. And the reason for that is, right, as we look at the requirement here, if you want to be an S Corp, then it has to be a domestic, not a foreign, right? So when they say domestic, a U.S. corporation that has no more than 100 U.S. shareholders, and there's only one class of stock. And in this framework, right, family members and their estates are going to count as one shareholder, right? So here's kind of an S Corp. You can think small and simple. You can't have more than 100 shareholders. They got to be individuals, generally. The shareholders have to be U.S. residents or citizens. The underlying corporation has to be a domestic corporation, and there's only one class of stock. And then we said, hey, family members, right, if you meet within this test here, right, within, let's see here, 1, 2, 3, 4, 5, 6 generations, right? So you can generally just think family members. The idea with this is they're going to count as a single shareholder, right? So here we have 3, 6, 8 people, right? If they're all family members, they only count as one shareholder. So let's look here at 21.1 and 21.2, all right? Okay, so it says the first fact set, we have a legal corporation, and hey, one of the shareholders is a corporation. Can this corporation that has a corporation as a shareholder elect S Corp status? Well, no, they can't, right? It generally has to be individuals, right? You cannot have an S Corp that has a C Corp shareholder. Likewise, the next one here, it says, hey, we have 97 individual shareholders plus 6 related family members. So there's 103 total. Can this organizational structure give rise to S Corp status? Well, yeah, it can, right? Even though it looks like we have 103, we really only have, in this case, 98 shareholders. The 97 individuals plus the one, right, that has 6 people in it, right? Because the family members, they're like one bubble there. All right, let's look at 22.2. This just says, hey, it has to be a domestic corporation, right? If you organize the underlying corporation under Canadian law, no, you can't have a Canadian corporation get U.S. S Corp status. But if you registered in the U.S., right, it was a domestic corporation, then you would be eligible, assuming you meet all other requirements. All right, so say you meet those requirements, the 100 U.S. shareholders with one class of stock. How do you go about doing this, right? Well, we said it's a tax status and you have to make an election, right? You kind of have to check the box there and say, I want to be an S Corp on Form 2553. And in this way, the general rule is going to be that you have to have unanimous consent. In other words, all shareholders must agree. Now, from a time perspective, how does it work, right? Well, you're generally going to have this 2.5 month mark. So if you think 2.5 months, that's January, that's February, we're landing there in the middle of March. So it's kind of confusing because it's like March, but it's 2.5 months, and March is the 3rd month. So you can just think 2.5 months on it. So if you make it in that window, right, they're going to make your S Corp status effective as of the beginning of the current year. In distinction, if you make the election after that 2.5 month mark, then your election is going to be effective at the beginning of next year, right? So what is this saying, right? So, hey, if you make the election, right? Hey, we're here, we make the election right here, we're in that window, then we're going to punt you back. You were an S Corp effective as of the beginning of the year. If, however, right, you make it after this window, hey, it's April, right, they're going to punt you into the beginning of next year, right? So 1/1 year 2 would be when your S Corp status becomes effective, right? That's going to be the general rule. Right, so anytime there's a general rule, there's got to be an exception, right? And here's the exception. It says, even if you make the election within the 2.5 month window, right? You're right here. Hey, we made it in that 2.5 month window. They're gonna send us back in time, 88 miles per hour, right? To get the flux capacitor, we're going back to January 1st. Even if you do that, there is a way that we can punt you to the next year. Right, so specifically, what's the idea here? Well, if at any time during this 2.5 month window, right here, right, that's great, you made it in the window, but if at any time during that window you did not meet the S Corp eligibility requirements, so hey, you didn't have 100 U.S. shareholders, maybe you had 110, maybe it wasn't a domestic corporation, maybe you had a C Corp as a shareholder, right? If any of these violations of that requirement to be an S Corp happen, then they'll punch you into the next year. Likewise, if all of the shareholders do not agree in that window, right, then they will punch you into the next year, right? So what does this mean? So general rule is right here, right? If you make it in the 2.5 months, they're going to send you back. The exception, right, is even if you make it here, they can punch you into the beginning of next year if, one, you do not meet the S Corp requirements at any time during that window, or two, if all shareholders do not agree. And what is the tricky thing here, and you got to be careful of it, is say that you have, right here in this window, right, one guy who sells his stock to another guy, right? And say whenever they make the election right here, this guy owns it, right? So they get his approval. That's great, right? He's going to do it. But they forget about the old shareholder, right? He's not there on, whatever that day is, March 1st. If they fail to do this, right, if they don't get his consent, the old guy, right, then they're going to punch you into next year. That's what this is saying right here, including if a shareholder disposes of their stock before the election and they fail to consent. All right, so we talked about forming an S Corp, right? That's great. You have to make that election. We talked about the timing there. Now let's talk about like the back end, right? Where, looking at the end of the road, things are coming to an end. How do we terminate our S Corp status, right? It's like the Terminator, right? Well, I'll be back. How does this work here? Well, it's more like I'll be gone because it's over. Well, in this framework, right, you have, first off, two types of terminations, right? You have a voluntary versus an involuntary termination. And with regard to a voluntary termination, there's kind of like two subsets, with a specified date and without a specified date. So let's look at this here, right? Voluntary terminations generally is like, hey, people come together, we don't want to be an S Corp anymore. And you generally are only going to need a 50% vote here, right? This is different from that 100% requirement to form it. So, hey, if you get half of the ownership to agree, we don't want to be an S Corp, that's great, right? You just fill out a form with the IRS, you let them know. But the question then becomes, when you fill out that form, when you make the voluntary termination, when is it effective, right? Now, the idea with this is you can specify the date, right? Hey, maybe we're in January, right? We say, we fill out the form, we get the required vote, and we say we want this to be effective as of March 1st of this year, right? So that would be a voluntary termination that specifies a revocation date. And accordingly, because we call out, we specifically say March 1st, hey, it's effective March 1st. But say that we filled out the form, we got the agreement, but we didn't specify a revocation date, right? Here we are in February, everybody comes together and we just say, hey, we don't want to be an S Corp anymore. Let's just, inform the IRS. The idea here is we're going to have to look and see when it was made, right? In other words, if you have a voluntary revocation that does not specify a revocation date, if the revocation is made in 2.5 months of the beginning of the year, it's going to be effective as of the beginning of the year. And if it's made after 2.5 months, it's going to be effective as of the beginning of next year. Right, so what does this mean? This is just those rules we just saw, right? If you get it, right, you make the election in that first 2.5 months. In this case, it's a voluntary revocation, and you don't specify the revocation date. Hey, they're going to punch you back and say, over here is when you terminated it. If you make it afterwards and you don't specify the revocation date, then they're going to punch you into the beginning year, or in the beginning of the next year, right? In other words, hey, as of the end of year one, your S Corp status will be terminated. Okay, so let's just look at 22.5 here. So, hey, here's this is with regard to formation, right? When's it effective? 22.3. 22.4 here. This is showing with regard to formation, that pre-election period where you have to meet all the requirements. And then 22.5, right, we're looking at the termination, right, the terminator here. So this is just saying, hey, you only need 50%. And if you make it in the first 2.5 months, we'll revert you like blast in the past, 88 miles per hour back in time. But if you make it outside that window, we're going to put you into the future, right? So it's like Back to the Future 1 versus Back to the Future 2, and then I guess in Back to the Future 3, they go Back to the Future again. Back to the Future 3 isn't like that great. The first one is the best one for sure. But the idea, the big thing here is that 2.5 month window. That comes into play not only in forming the S Corp when it's effective, but it also comes into play when you terminate the S Corp status and you do not specify a revocation date. All right, next let's talk about involuntary revocation, right? So what does this mean? Well, this is basically when you have a big no-no, right? Something happens and you no longer automatically, immediately, as of the date the event occurs, you will have your status revoked. And that's going to be specifically if you do not meet the S Corp requirement. So if at any time we're chugging along here, we're an S Corp, we're an S Corp, we're an S Corp, at a point in time, if we fail to meet that S Corp requirement, 100 U.S. shareholders, right, all of the kind of nuances with it, immediately, right then and there, our termination is effective involuntarily, right? So, hey, you sell your stock to a C Corp, right? There's a shareholder who sells it to a C Corp, immediately, right then and there, it's an involuntary revocation. Likewise, right, and this one says here, if we have too much passive investment income, specifically if it's an S Corp and there's no E&P from when it was previously taxed as a C Corp, right? In other words, if we have too much passive investment income, namely more than 25% of our gross receipts for the prior 3 years, then we also will have an involuntary termination. And the effective date on this one is the first day of the year following the 3rd year with the excess passive income. That's a mouthful for just saying, hey, we have year 1, we have year 2, we have year 3. We have so much passive income here for our S Corp passive investment income. Effective as of 1/1 year 4, our S Corp status has been involuntarily terminated. Right, so let's look at 22.6, 22.7. This just says, hey, it looks like we have a shareholder. They sell some shares to a C Corp on 6/15. Right then and there, right, that would be whenever we're done, right? We're terminated involuntarily. And for that reason, right, we fail to meet the S Corp requirements. This one just says, hey, we have an S Corp. Looks like they have passive investment income exceeding 25% of gross receipts for the 3 years. This one just says, hey, we're always taxed in S Corp, so there is no E&P, right? If we go back, the idea here is it only applies to S Corps with E&P. What does that mean, right? E&P. So the idea with it, we'll talk about it in the next lecture, but essentially, if you were previously taxed as a C Corp, right? So let's just say year 1, year 2, year 3. I'm a C Corp, 1120, 1120, 1120. There's something called earnings and profits, right? And it's essentially like tax retained earnings. It's income that you made that you kept in the C Corp, right? And the idea with this is that stuff builds up over time, and it's going to be your accumulated earnings and profits. You can think of it like retained earnings, right? It like builds up. So that's kind of choice 1, where you can have, your first 3 years, you can be a C Corp. Then in year 4, you elect to be an S Corp. And in that way, you'll be an S Corp with E&P from the prior years that you were a C Corp. In distinction, right, you can be an S Corp like right off the bat, right? Hey, we form and are taxed as a C Corp in year 1. we immediately make the election to be an S Corp. There is no E&P, right? Like kind of de facto, we've always been an S Corp. So we'll talk about that next lecture. I'm just kind of prefacing it for when we get there. But the idea here is, the second one is, we do have E&P, right? We have some throwback. We used to be taxed as a C Corp. If you have too much passive investment income, right, year 1, year 2, year 3, right, then they say effective as of 1/1 year 4, right, the first day after that third year, our S Corp status is involuntarily terminated. All right, so this is just kind of showing you the different nuances with it. All right, so the next thing to be aware of, right, well, when you terminate, right, when it ends, it's going to create a short tax year, right? Say right here we terminated, whether it was voluntary or involuntary. The real world is not like your financial accounting textbooks where everything happens on 1/1 year 1 and everything is neat and clean. A lot of times these decisions in ending a business, right, it's just the way the world works. So hey, let's say that just on this date we failed to meet the S Corp requirements, it killed our S Corp status. This creates 2 short tax years. In other words, we're going to have part of the year we were an S Corp and part of the year that we were a C Corp, right? So how does this work if for the whole year, right, the entire year, I don't know, let's just say we had $1 million of income, right? Well, the idea with this is we're going to have to allocate the income to, some of it for the S Corp year and some of it for the C Corp year. How we do that, right, is this kind of setup here, right? There's going to be 3 steps. Step 1, we calculate the per day income. Step 2, we're going to allocate the income to the S Corp year. In step 3, we're going to allocate the remaining income to the C Corp year. So let's look at an example here on this, 22.8. Okay. So this is saying, hey, we have an S Corp that terminated on 6/15, right? And the idea here is when we looked at everything, right, there was $365,000 for the entire year, right? So here's the setup with it. We have to allocate that between the part of the year that we were an S Corp and the part of the year we were a C Corp. There's 2 methods you can use, right? The one that we're looking at here is the daily method of allocating income. There's also, right, specific ID method, but the general rule is going to be the daily method of allocating it. And essentially, right, we said we have 3 steps, right? So we got to do step 1, figure out our per day income. All right, well, we made 365 for the entire year, 365 days. Hey, per day we made $1,000, okay? And step 2, right, we have to allocate the income to the S Corp year, right? So if we made $1,000 a day and 165 days we were taxed as an S Corp, then hey, of that 365, 165 is going to go to the short year when we were an S Corp. Step 3 just says, hey, whatever's left over, 365 minus the 165, right, the remaining part, the 200, is going to go to the C Corp year, okay? And that's using the daily method of allocating income, right? There's a little bit of math. The flip side of that would be this specific ID, right? The specific ID says you kind of dig in to the timeline, right? How much income did you really earn during that time, right? Well, 100,000 when you were an S Corp, there you go. How much income did you really earn when you were, those 200 days, right? You specifically call it out, 265, right? There's the idea with it. So it's just a different framework, right? The general rule is going to be you use that per day income, but hey, if you have the ability and you want to specifically ID it, you can do that as well. So next thing here, just kind of buttoning up this lecture. So your S Corp status has been terminated, right? Say you now want to be an S Corp again. Well, they're generally not going to let you game the system, right? You can't be like, I'm an S Corp 1 year, I'm a C Corp the next, I'm a partnership, I'm this, I'm that, right? The general rule here is going to be a 5-year window. In other words, once an S Corp status has been revoked, terminated, involuntary, it cannot re-elect S Corp status for 5 years without IRS permission. Now there is an exception here, right? Sometimes you can get below that 5-year window if you basically have new shareholders where the original termination wasn't reasonably in the control of the shareholders. But overall, you're looking at, hey, your S Corp goes down, it's terminated. You can't be an S Corp again for 5 years, right? So there's the idea with it. Let's see here. So accounting periods and methods. Let's finish with this right here because this is, no, we'll take it a few more slides because we have about 50 slides here. So accounting periods and methods. We've seen this before. Generally S Corps, they can use cash or accrual. If, however, they're considered a large taxpayer, namely average gross receipts over the prior 3 years of 29 million, then hey, you must use accrual method. Likewise, if inventory is a material income producing factor, then you got to use accrual for your gross profit, your sales minus that cost of goods sold, right? Because that's tied into your inventory. Generally, right, with S Corps, you're going to be using your calendar year end as the tax year end. What's the setup here, right? With S Corps, you're generally looking at a 3/15 deadline, and when they punt it out, right, the extended deadline is 9/15. Okay, so let's talk a little bit about income and loss allocation here, right? So the idea with this is that whenever you have an S Corp, they do not allow special allocations, right? So special allocations, sorry, that's a bad spelling there. Can't do that, right? We said with partnerships, you are allowed to do it. What is a special allocation? Hey, you're a 10% owner, but we're going to give you 25% of the profits, right? And it works for deduction, loss items as well. Generally, right, when you're talking about S Corps, it's got to be based on your ownership percentage. And that's the idea here. So it's got to be pro rata based on the number of outstanding shares each shareholder held during the year. So you can't have special allocations. And likewise, that means there can't be disproportionate distributions. In other words, it's got to be even Steven, right, based on your ownership percentage. You can't give, this guy, 20% of the profits, that guy 30, right? It's got to be based on your ownership percentage. Now, generally, right, how do we figure out this ownership percentage? Is we know that profit and loss, income and loss have to be allocated pro rata. So what you're going to do here is this daily income method. That's going to be the general rule. However, you also can use normal accounting rules. All right, and in this framework, right, a couple things here. You can have constant ownership interest or you can have changing ownership interest. So you can look at that here. This one's a little bit easier to look at through an example. So hey, here's a lot of math, but let's kind of summarize what's going on here. All right, so we have a shareholder. They sold their 50% interest consisting of 50 shares in an S Corp on April 30th. Right, so we got a sale on 4/30. Okay. And it looks like the S Corp had net ordinary business income for the first 4 months of 140 and 400 for the entire year, right? So we care about that entire year amount here. That's going to be the important number, the entire year amount, the 400,000. The separately stated income totaled 2125. And on April 30th, and there was 50,000 for the entire year. Okay, so again, we just care about that entire year amount. So it says, using the per share per day method, what is the amount of income the shareholder has to report for year 6 as the result of the sale, right? So here is what is going on, right? We're kind of in this framework right here, A, B, C, and D, right? D sells, owns 25 shares, and they sell all 25 shares. We got to figure out and allocate income to D for that first 100 days, right? For here, however many days it is, 120 days, right? So here, 120 days in, so they held it for this period right here. And we got to allocate the income to them. All right, so how do we do this, right? So there's going to be, again, a 3-step process, right? You're going to do step 1, step 2, step 3, and you do it for the net income and the separately stated items. So you just repeat the same thing. Let's look at it here. So first thing we got to do is figure out our per share allocation. So hey, there was 400,000 of ordinary business income, and we had 100 shares, right? So 50% interest with 50 shares. That means, hey, there's got to be 100 shares, okay? So then, hey, each share has $4,000 of income, of the net income. All right, that's great. Next thing we do, and we say, okay, that was based on the annual amount, right? Remember the $400,000 was the annual or for the entire year amount, but we want to figure it out on a per day amount, right? So we said each share got $4,000 for the entire year, but if you divide that by 365, that means 1096 per day allocation, okay? And then you say, all right, well, 1096 per day, right, per share. This guy owned 50 shares. Right, he owned 50 shares for 120 days. Well, hey, you just do a little bit of math here. 1096, the per share per day income. He owned 50 shares for 120 days. Hey, he gets $65,000 of the income allocated to him. Right, that's what we're going to push out on the K1 there. Same process here for the separately stated items. Right, so I would be more focused on this guy right here. Do know this math. This is important. Don't get as concerned with this kind of scenario down here. It gets a little bit more wonky. There's just a little bit of math involved, like 120 versus the 245, the remaining of the days of the year for the remaining interest. If this were to be tested on the exam, it would be more of, hey, some guy owns it, he sells his entire interest. Okay, and then this is just saying that, hey, like partnerships, we have to allocate, and we've just saw, like, how do you do this, right? Our ordinary business income and our separately stated items. A few things here, right, with S Corps to be aware of. There's going to be no guaranteed payments to an S Corp. So, yeah, you get those for partnerships, but you do not get those for S Corps. Similarly, right, you can get that 20% QBI deduction if you're an S Corp shareholder and the income flows through to you. But there are some things, right, while we said an S Corp is like a C Corp, there are some different tax characteristics, right? So S Corps are generally not going to be eligible for the dividends received deduction. Likewise, they're not going to be subject to special C Corp taxes. So for example, the alternative minimum tax, the accumulated earnings tax, or the personal holding company tax, right? So what are, again, some of the differences we've seen and noted here between partnerships and S corps, right? Well, a big one is, right, you can't have special allocations, right? With a partnership, you can't. With an S corp, you can't, right? It has to be pro rata. Generally going to be that per share, per day amount based on ownership percentage. Likewise, we said that there's no guaranteed payments for S corps, right? If you're an owner, you're a shareholder, you don't get guaranteed payments. We'll look and see. You can be an employee of an S corp. And then a third difference that we're going to see in the next lecture with basis, right? So, this is just kind of priming you here for the next lecture. We're going to talk about basis with S corps, right? You need to know your basis in that stock. And one of the differences, while we're looking at differences, is that when you calculate your partnership basis, you have your percentage of the partnership liabilities be part of your basis, right? So if you remember that lecture from chapter 20, the partnership had 60 grand of liabilities of debt they owed. You're a 1/3 partner. You get 20 grand of that into your basis. Generally with S corps, and we'll see there's a kind of an exception, a setup here for debt basis, but generally your tax basis as an S corp would not include that your percentage of that outside debt to external parties. So again, here's kind of the breakout between non-separately, right? That's like ordinary business income versus separately stated items. Here's some separately stated items, right? Why do we care about them? Well, hey, they're going to have special tax characteristics at the owner level. But with that, right, it looks like we're about halfway through this deck. So let's pause here. We'll end lecture 1 at this note.